Jamie is a fifth-year student. She has recently started working part-time as a waitress at a local restaurant. This is her first job. Because Jamie is an employee, her income will be taxed under the pay-as-you-earn system, or PAYE. The PAYE system is used to collect tax on a range of incomes, such as salary, wages, overtime, tips, occupational work pensions and some social welfare payments. However, not all income is taxable. Some social welfare payments, lottery winnings, scholarships, and prize bond winnings are examples of non-taxable income. So, how does the PAYE system work? Under PAYE, your job must be registered with Revenue. As this is Jamie's first job, she must register her job herself, using the Revenue website. However, if it was not her first job, her employer would register her. When Jamie's employment is registered, Revenue will send an instruction, called a Revenue Payroll Notification, or RPN, to her employer. Using the RPN, Jamie's employer will calculate her income tax, universal social charge, and local property tax, if Jamie is paying that through her wages. Each time Jamie is paid, her employer will ask Revenue for a new RPN, to ensure that they are using the correct calculations. Jamie's employer also calculates her pay-related social insurance, or PRSI. Although not a tax, PRSI is collected by Revenue through the PAYE system on behalf of the Department of Social Protection. After calculating the amounts, Jamie's employer sends these deductions to Revenue. Jamie's employer pays Jamie's wages, and provides her with a payslip. There are three key elements to calculating income tax under the PAYE system: tax rate band, tax credits and tax basis. The first element is the tax rate band. This is the amount of income which will be taxed at a particular tax percentage, or tax rate. Currently, the two income tax rates in Ireland are 20% and 40%. If your income is below your tax rate band, all your income will be taxed at 20%. If your income is greater than your tax rate band, the amount below it will be taxed at 20%, and the amount above it will be taxed at 40%. Your tax rate band is used to calculate your gross tax. This is the amount of tax you pay before any deductions. Your tax rate band is based on your individual circumstances, for example, if you are single, or if you are married, or in a civil partnership. Secondly, let's talk about tax credits. These are applied after you calculate your gross tax. They reduce the amount of tax that you pay, and are given for the full year. Each tax year is separate. If you do not use all your credits in one year, you cannot carry them into another year. The tax credits you receive depend on your circumstances, including personal status, dependents, age, and health. A wide range of tax credits is available, with a full list shown on the Revenue website. The two most common tax credits are the personal tax credit and the employee tax credit. Each person resident in Ireland is entitled to a personal tax credit. This amount depends on your personal circumstances. The employee tax credit is available to most employees in Ireland. The final element we will look at is the tax basis. Your tax may be calculated using one of three tax bases. Emergency tax. This occurs where your job is not registered with Revenue or you haven't given your employer your PPS number. Week 1. On a Week 1 basis, each payslip is calculated separately. Unused credits or rate bands from a previous payslip are not carried forward. This may also be known as a Month 1 basis, where an employee is paid monthly not weekly. Cumulative. On a cumulative tax basis, your credits and rate bands are accumulated from the 1st of January to the current date. This is the preferred basis for calculating tax.